The Salzgitter steel plant in Lower Saxony is operating at full capacity. But despite order books full to bursting, the company barely makes a profit, and it's been that way for years. Salzgitter executives think China bears a large part of the blame for dumping its excess steel production at rock-bottom prices in Europe. The company's management and unions are both calling for import barriers and tariffs to be imposed on Chinese steel. Because it's not a level playing field. China's steel industry is state-subsidized, whereas our sales don't even cover our production costs. In the long term, we're talking about the death of the German steel industry. This kind of rolled steel is used to make products like cars and washing machines. Chinese companies undercut Salzgitter's prices in Europe by a full 40%. German steel producers can't compete with prices that low, and they also have to comply with strict environmental regulations. The Industry Federation insists China is not a market economy and is churning out far too much steel. Around 400 million tons overcapacity in the steel sector. That's twice as much as we produce in Europe. And these overcapacities are exported onto global markets. China's exporting its structural problems, which result from non-market economic behavior. The steel industry once dominated the landscape of entire regions, but now it's in decline. The sector now generates a mere 2 to 3% of German GDP. German steel companies are teaming up with European partners to lobby for 6 months of import tariffs on Chinese steel. But economists warn against putting up trade barriers, saying the Chinese could easily respond with tariffs on German machinery. And if both sides would get together to talk about quotas and specialization and start organizing the division of labor more internationally, then trade barriers or negative effects would be smaller in the future. A plea for talk instead of a trade war, for negotiation instead of confrontation, and open markets rather than protectionism.